After 4 years, Pakistan issues a $1 billion Sukuk Bond. Pakistan re-entered the Islamic Sukuk Bond market on Monday, raising $1 billion at a yield of 7.95%, compared to the original price gold range of 8.25 to 8.37%. Perhaps the highest yielding asset-backed Islamic Sukuk Bond for Pakistan. When the governing PTI was in opposition, it contended that the country's assets were mortgaged to secure debts. During PTI's 41-month reign, several cabinet members objected to the plan for issuing the Sukuk Bond. In response to growing external vulnerability, Pakistan has raised $2 billion via foreign bond issuance this fiscal year, compared to a budgeted $3.5 billion for 2021-22. 1 billion Eurobond in July 2021, and now 1 billion Sukuk Bond in January 2022. Pakistan issued a $1 billion Sukuk Bond in 2014-15 at a fixed rate of 6.75%. Islamabad issued $1 billion Sukuk Bonds for 5 years in October 2016 and December 2017 at 5.5% and 5.625%, respectively. Despite the government's assurances that the economy has steadied, the highest ever Sukuk Bond rate is currently available. The issue of Sukuk Bonds before the IMF program renewal has been criticized by many experts. It may have been cheaper with the IMF. In order to regain the IMF, Pakistan has done everything possible, including raising interest rates. The government guaranteed M2 sections for the $1 billion Sukuk Bond. It has set up a special purpose vehicle, SPV, to issue the Sukuk Bond. Pakistan has traditionally used the Malaysian model for issuing foreign bonds, which are connected to the US Treasury through LIBOR, London Interbank Offered Rates. A rise or fall in an asset's construction index is linked to a markup in the DBE model. The State Bank of Pakistan possessed about $17 billion in liquid foreign reserves. The SPP's foreign currency reserves fell by $562 million last week. Despite $3 billion in Saudi Arabian deposits and $2 billion from the IMF, the foreign currency reserves have fallen by over $3 billion in recent months. The country's current account deficit increased to $9.1 billion in the first half of the current fiscal year, July DEC, and may reach $18 billion. However, Pakistani officials anticipate pulp prices to fall in the coming months, as well as shipping costs, easing the overall demand on imports.